everybody. Welcome to the fourth in our 5-part series for the summer, replacing our trip to Toronto. I'm really excited today. I really like this crypto topic a lot. You may have seen we did a crypto discussion in the spring, and we will this is a 3-part series, so this is the second in our series, and we will revisit the topic again in the fall when we have our fall series. Shall we go a little deeper today? This is absolutely unbelievable. There have been some changes in the markets. We'll talk about all of that. And there seems to be some institutionalization going on. And we will talk about that as well. So I just want to mention, as I do every time, that the comments and opinions expressed by our speakers today are their own, not necessarily reflective of the companies they work for. And I want to thank our sponsors, of course. I want to thank O'Brien Investment Group for bringing us this idea. It's been so popular, just really exciting. And then Strix Leviathan came on this summer to bolster this conversation. Very exciting. I want to thank Efficient Capital and Lixor and InfraHedge and AlphaDense and Auspice and Bodhi Research and Crable Capital. And I want to thank FAR Capital and Graham Capital and Unigestion. We just have a wonderful sponsorship behind us, which is terrific. I also want to thank our industry association partners, AMA and CASA and Kaya, who help us get the word out about these. And I guess that is all I need to say. So Scott Army, our moderator, would you pop your camera on? And Nico and John and Tracy. And I'm going to go away and let you all take it over. Have a great conversation.
Awesome. Thanks, Meg. Welcome, everyone. We have a very exciting panel today. I think it's very timely, this conversation. Our panel today is Cryptocurrencies, Where Do We Go From Here? Joining us today, we have Nico Cordiero, CIO of Strix Leviathan. We have Tracy Fong, partner at Alborn. And we also have John O'Brien, CIO of O'Brien Investment Group. So my name is Scott Army. I am the Chief Investment Officer of Galaxy Vision Hill. Galaxy Vision Hill is the multi-manager fund-to-fund business within Galaxy Fund Management. Previous to the acquisition by Galaxy recently in May, I was the CEO of Vision Hill Group, a premier investment consultant and asset manager in the digital asset space. So our panel here is where do we go from here? Some of the things we're going to be talking about are the current state of the market and recent events. We'll level set there first. Types of investors investing into digital assets, market structure, and types of investable strategies. And then we'll try to take some actionable takeaways and set opportunities here into the balance of the year and especially 2022. So I'm going to let each panelist introduce themselves here. Let's start with Nico first.
Hey, Scott. Thanks for the introduction. As Scott mentioned, I'm the Chief Investment Officer at Strix Leviathan. Strix Leviathan is a systematic fund that has been algorithmically trading the cryptocurrency space for the last 3.5 years. And at Strix, I oversee strategy development, risk management, quantitative research, and trading operations.
Tracy, to you.
Thanks, Scott, Meg, and to all the participants. My name's Tracy Fong. I'm a partner at Alborn, a leader in non-discretionary alternative investment advisory. By way of background, I've been involved in manager allocations dating back to the mid-2000s, corporate venture capital, and endowment management. As far as Alborn's involvement with crypto, we have been tracking Bitcoin since 2014, some of the early hedge fund flows, and have conducted and started manager research as far back as 2017, given the rise of some of the managers. We think that we have some good market leadership in terms of investment due diligence and venture capital funds, as well as the breadth of perspectives in operational due diligence.
Thank you, Tracy. John?
Hi, my name is John O'Brien, and I do a number of things for our family. I'm on the board of R.J. O'Brien, the world's largest and oldest independent FCM. We're onboarding accounts to trade Bitcoin and Ethereum futures at CME, ICE, and Bitnomial. I'm on the investment team at the family office, where we're investing in the crypto space via venture. And we break that down between decentralized venture, where we're investing in protocols and tokens. And the word du jour for this is DeFi. And we also invest in centralized DeFi, or centralized venture. And kind of staying within our circle of competence of trading and brokerage and exchanges, and applying that to the nascent companies that are building infrastructure in the crypto space. And lastly, I run our boutique hedge fund group called O'Brien Investment Group, or OBIG for short. We have our flagship quantitative gold macro fund, which we added Bitcoin and Ethereum to at CME. And we also use our infrastructure to launch a digital asset fund, where we use a variety of quantitative models to trade Bitcoin and ETH futures. Some of these models are momentum-based, diversified across timeframes and logic, and the rest are machine learning models based across various timeframes, from short to long term. There's also a little discretionary trading in there, which is more short-term swing trading, and we manage a basket of tokens on the long side.
Awesome. Thanks everyone for introducing themselves. So it's been a very interesting market the first half of this year. We saw coming in, we saw a pretty significant rally in Q1 that lasted into April, and then we saw a pretty sharp pullback in May and June, and now a little bit of a bounce. So Nico, I'm going to come to you first just to contextualize some of the recent market events and maybe how you at Strix take a quantitative approach and adjust your strategy to those moves in the market.
Yeah, absolutely. I mean, the biggest news over the last several weeks has been on the regulatory front. So after years of rumors that China was going to crack down on mining, they actually went through with it starting in May. And we've seen, mining entities across that country shut down, sell off their assets, either because they're calling it quits or because they needed to move, they needed capital to move all of their ASICs and machines across borders. And we also saw the Chinese government limit access to some of the liquidity venues that Chinese citizens were using to trade cryptocurrencies. So we have good reason to believe that shutdown contributed quite a bit to the bearish flows and kind of broke the bulls back, if you will. And since then, there's just been a deluge of regulatory notices really across the globe, with a seemingly particular focus on exchanges that still operate with minimal KYC and AML procedures. And we've seen that this week, even in the U.S., there was hearings on Capitol Hill around, how do we regulate this industry? How do we protect investors? Basically the U.S. government is starting to put the pieces together to kind of figure out how they handle this asset class. Longer term, I think that's good. It's a benefit to the burgeoning asset class, but in the short term, the uncertainty around exactly what those regulations look like is certainly causing some market angst.
Got it. Can you talk a little about, some of the signals from your quantitative strategy and approach that you would try to pull in to adjust around some of those market factors that you just touched on?
Yeah, absolutely. I mean, similar to John, we run a variety of quantitative models. Some of these are price momentum, trend following, divergences, technical in nature, and we also, run a couple machine learning models. And all of those are, we diversify across assets, we diversify across time frames, and that's largely how our system functions today. But like John mentioned, there is some discretionary in there because the asset class changes at a whim. I mean, like you mentioned, Q1 we were up, some assets up 500 to 1,000% in a single quarter, and then down 90% since the May highs. So it's quite a wild ride.
John, coming to you because you have, I think, an interesting perspective where you see both the client side demand, via the SCM, and then obviously you have your own strategy. So what have you seen, given the volatility in the market recently from kind of both sides there?
Yeah, I mean, I think I can start on the RGO side first. It started early last year. We got a lot of inbound interest from crypto native hedge funds and bona fide hedgers, being miners and wanted access to Bitcoin futures and options. Then after COVID, we started getting interest from family offices, and they just wanted long exposure really via futures because of the macro backdrop at the time and the amount of fiscal stimulus that was being injected into the system. So within that backdrop, Bitcoin really fit in. That long exposure was a problem then because the negative roll yield was so high. So we would help them with option strategies to try to, get back that cost to carry. But yeah, that's not a problem anymore, though, as the basis has collapsed, and with it, the cost of rolling long at CME. And this year, it's been traditional hedge funds and asset managers that have been reaching out, wanting access to the futures markets here in the U.S. in a regulated way. And they either want to add Bitcoin futures to their legacy funds for diversification purposes, or they want to launch new funds and trade futures and options in it. So that's been most of the discussions we've been having of lately. They're seeing the volatility. They see that there's a lot of edge in the market. It's long-term bull markets, lots of volatility, market follows through. It's really inefficient and fragmented across various exchanges across the world. So there's a lot of inefficiencies, and a lot of these asset managers are seeing that there's alpha there. And then on the hedge fund side, the OBIG side, we haven't seen much institutional interest really quite yet. We only have a 7-month track record and 5 million in assets. And institutions typically want a longer track record, and their check sizes can't make up a certain percent of overall assets, under management by the manager. We have had interest from family offices and RIAs. They're looking, they want to learn more about Bitcoin and Ethereum, what the other options are out there. But really hasn't been a rigorous due diligence as of yet. But we're ready for those, since we have been through a lot of that many times with our flagship quant fund. So that's kind of what I'm seeing from both the FCM side and from the hedge fund side.
That's great perspective. So, Tracy, I'm going to come to you. Your perspective is a bit different than Nico and John, in the sense that you're not running a direct strategy. Allborn is looking comprehensively. So maybe I'd ask you kind of to zoom out for us and take us maybe through the history of engagement at Allborn with digital assets and how that has framed in your eyes.
Sure. So, as I mentioned, we had begun tracking some light hedge fund flows into Bitcoin as early as in 2014, and we continued to kind of track and monitor the pricing related, as well as early sort of green shoots in terms of some bubbling up activity. But just as John said, there hasn't been notable institutionalization on the hedge fund side, and as much as that we expect going into the market maturity today. And so a lot of what we saw, very similar to what John had observed, was in 2017, there was sort of a rise of more hedge fund and other investor participants at a very sort of retail, non-institutional level. I think at one point there were in excess of 150 hedge fund filings for crypto-related trading strategies, but very few of them came into fruition, and very few of them are as I think institutional as John and Nico are today. Fast forward to 2020. Similar to John's observations, many of the LPs that we worked with wanted a play on inflation, and as part of that, from mid-2000 to the end of 2000, early 2021, many of the LPs that we looked to, rather than investing in futures, maybe we weren't as purviewed to that. Many of them looked to acquire the underlying, mostly Bitcoin, kind of passive beta exposure as a play to inflation dynamics. I think some of the LPs that we worked with were fast enough to move early in the cycle, and that played out nicely. Alongside that, you may have seen, and you in particular, Scott, having monitored the venture market actively, you may have seen a proliferation of venture capital funds, in some cases coming back to the market in the last 6 to 12 months or so, and that's been much more actively invested by many of our clients in our client base, mostly endowments, foundations, and family offices, as John and others have cited, but we have started to see pension fund activity as well. So I think as we observe sort of the value chain of the kind of allocation model, that asset allocation approval at the board level, portfolio construction as it relates to, what sort of hedge funds and VC funds and other implementation can we utilize to access the space? And then finally, what sort of investment selection makes the most sense in the context of what we're observing across investment due diligence, and of course operational due diligence, which we can touch on in a few minutes.
Sure. And I think we've definitely seen an evolution of the types of investors in the space. So I would completely agree with you. I want to dig in on that, but before we do, I'm gonna ask Ken to kind of pull up our interactive survey here. For everyone, hasn't done this before, including myself, you should see a survey in front of you that you can fill out. Would love answers to that. We'll pull that back in later in the conversation, and hopefully it can help inform some of the questions towards the end.
And I'll just very quickly make sure to scroll so that you can see all the questions farther down, and then click the submit button at the bottom to lock those in. And we'll bring those up later. Thanks. Go ahead, Scott.
Awesome. Thanks, Ken. So digging in on types of investors, like I said, in my view, I've seen it. We've gone from, early high net worth individuals, ultra high net worth individuals, single family offices, maybe into multifamily offices, being very progressive about allocating to digital assets when it became an asset class, arguably in 2017. It wasn't much of an asset class before that because it was a single asset. So we look at the audience attendees here to this panel, and we see a lot of very institutional folks. And I think the conversations certainly have moved in that direction. This is a question really for everyone. How have you seen that evolution of the investor base, and how has that affected sort of your strategy and your approach to, marketing? Not marketing, or you can't talk about that, but really just positioning, let's call it.
Yeah, I can speak to that, Scott, because our experience maps to exactly what you just said. When we started 3.5 years ago, the LP base was pretty much only high net worth individuals. And it remained much like that through 2018, 2019. Last year, as John and Tracy alluded to, there was kind of a step size change in the type of allocators we were seeing. So, today in the fund, we have family offices, fund to fund, wealth managers. And so we're definitely moving towards more institutionalization, but it's still early. Like the family offices that we have in our fund are pretty forward thinking, I would say. We still don't see a lot of endowments. We still don't see a lot of more traditional allocators. It's more of those who are, willing to take a risk or a bet on the asset class.
John, have you seen certain types of clients, especially on engaging on as futures have created more depth here, as some of the options market has created more depth? We've had some regulated options in the U.S. We've also seen a lot of stuff happen offshore and a lot of liquidity in certain platforms that are, in a regulatory gray area. What have you seen there from a client base and interest evolution?
Yeah. Well, I guess I can kind of talk about what we're doing as a fund a little bit in that regard, because yes, the majority of the derivative volume is offshore in an unregulated way in that kind of gray area you just mentioned. So, as a firm, we try to stick to the onshore regulated or somewhat regulated, being like a Coinbase for our spot exposure, and then CME or ICE or Binomial for our derivative exposure in a regulated way through the FCMs. Where it's centrally cleared, in my opinion, because I come from Chicago, but the old Chicago way of managing risk is the best way. It's the best way to decentralize risk. So we try to stick with those venues. And from a portfolio standpoint, since we're not really targeting institutional investors at the moment, we can run a little bit higher vol because family offices and high net worths seem to have more of an appetite for that. And then the bigger institutions, they typically don't. In my opinion, Tracy could probably correct me if I'm wrong there. But yeah, that's kind of what I'm seeing from that perspective.
Got it. And Tracy, we were talking about this earlier in the week. I think it started as a Bitcoin conversation, and you mentioned, there was maybe a report that you put out regarding Bitcoin in the early days, and now the conversation certainly evolved. So, how have you seen the reverse inquiry from your client base evolve across the product spectrum in digital assets and the type of investors now that you're interacting with today?
Sure. I won't be too redundant with what I said earlier and what the panel here cited, but again, very sort of early kind of experimental activity in Bitcoin exposures from 2014 to 2017 by managers, and then 2020 was a time period for which many of our LPs across more of the endowment and foundations here and more of the family offices, multifamily as well as single family offices, engaging in direct Bitcoin exposure as a beta play to inflation dynamics, less so on the Ether side, the underlying for Ethereum. But some early questions as it related to that through to the run up, was it, Ether versus Bitcoin in terms of underlying exposures? We did receive some questions as related to sort of passive indices as well. We're less active on sort of a long only type of exposures in that regard. So while we had some commentary and some client inquiry, I'd say that it was still kind of a question mark, especially as the ETFs were giving rise. And then more actively, some of that venture capital engagement, as there was that advent of much more venture capital fundraising activity in 2020 through to early this year, coinciding with sort of run up of crypto, which worked really well from a marketing perspective and dynamics for LPs. But one quick evolution is I've been seeing a little more on the co-investment and direct investment side. There were some really avant-garde family offices dating back to 2017 and 18 that did start to participate in some of these more centralized equity investments and tokens on a fairly disparate basis. Increasingly, as we are seeing some of these players allocate up to 1%, 2%, in some cases, some of these allocators allocating to that, they are exploring some of these more centralized equity investments. BlockFi comes to mind because it's easy to digest in terms of some of this asset management platform play just as an equity investment. And on a bespoke basis, we are seeing a little bit more inquiry into some of the tokens as well, which mirrors what we see more actively on the venture capital side.
Mm-hmm. Yeah, I think that's consistent with what we've seen as well, is where it feels like a lot of investors are arriving in a barbell fashion, either to the beta part of the asset and doing that themselves, or playing that through a passive allocation, or the other side, which is venture that you mentioned, right? And that seems to map to the longer term secular technology bet in the space. And therefore, a closed-end long vehicle of venture capital kind of makes sense there. And then in the middle, you have the active hedge fund strategies. I think Strix and O'Brien Investment Group here are two examples of where that kind of falls. On the quantitative side, you have fundamental quant and sort of some opportunistic market neutral stuff as well. Tracy, I want to, Allborn obviously is a market leader in many respects, from a diligence perspective. Can you talk a little bit about the criteria by which, you think about evaluating some of these crypto strategies, especially around some nuances in the space that might be different from traditional markets? I'll mention service providers as just sort of one of the things that is very different here.
Sure, absolutely. And, one quick comment on your last set of observations, Scott. I'd be remiss if I missed this point. I think some of the LP activity into or intent and inquiry into Bitcoin and Ether exposure upfront was in part because many of these venture capital firms utilized sort of beta play into Bitcoin and Ether as a significant portion of their portfolio up front, at least in order to access some of the exposure as they were allocating into other projects over time. So and it dovetails really nicely into your next question. Well, is it sufficient for a venture capital firm to explicitly invest in Bitcoin and Ethereum today? Probably not. And so what we are seeing in terms of interesting value-added skill sets would include sourcing and active lead and syndicate participation in some of the top projects. Oftentimes, I like to see some of the early participation in seed investments or private rounds of token issuances, often at a discount, playing some of the structural considerations of the market. So that can be value additive in nature. Technical skill set is important and increasingly more important, whether it's a real understanding of the long-term implications as the decentralized web or Web3 continues to play out, and having an understanding for how all of these projects piece together in that regard. Some more bespoke skills as the market is evolving is, smart contract auditing or an overlay on top of outsourced smart contract auditors. Node operations is really important. You can do it sort of on a simple basis in some cases on some projects like on top of Cosmos, but the deeper you can get in terms of node operations is really important. I think one of the creative things we've also observed is, how do you play the venture capital strategy for which you can try to get and garner as much ownership as possible up front while also being true to this decentralized ethos for which you're not a significant portion of the so-called cap table, if you will. And what we've seen is more active engagement by many VC funds alongside universities delegating their governance. These VC funds will delegate their governance to universities and other third-party active market participants in the market, which will allow for higher ownership in some of these projects, but more delegated and distributed governance. And we've found that interesting through to some of the participants, even in Asia. So we've seen some participants active, which may be non-obvious to some of the people in the audience that don't pay attention to the Asia markets as actively. I think a couple of other things include media and sort of PR outlet and activity. In the United States, for example, I hesitate to mention the manager, but many of you probably know there's a manager that raised about $2 billion in the last 4 months or so. They announced that they were going to create a more sort of active engagement with the media and form a media company. So what I observed was they were actively involved in sort of developing the consumer end of the market on utilizing their media capabilities on Clubhouse, on Twitter, through other content distribution to actually form and influence the complexion of the NFT and consumer market. So I saw that as an interesting strategy. And then lastly, on the regulatory front, I think we have a preference for players that have some perspective on the regulatory markets, both on a macro basis as well as a micro basis. So some examples of how that played out on a micro basis was in 2017, leading to the 2018, as some of the markets became sort of more questionable in terms of regulation. Some of the managers that we've looked at were able to, while being long-term hold participants in the venture capital markets, said, you know what, it doesn't feel like regulations are playing out as appropriately. We're going to trade out of our Bitcoin and Ethereum exposure into early 2018, and that played really well relative to other venture strategies. We can touch on custody and other operational due diligence items as you wish, Scott.
Yeah, I think one of the things to pull forth maybe before we move off of diligence is just, there's a lot of crypto nuance that doesn't exist in traditional markets. Custody is obviously a big one. I mentioned service providers. It's almost a completely different landscape, especially on the hedge fund side, across fund admins, banking, custodians themselves. And so there's an element of diligence, I think, that goes into learning the new ecosystem in addition to the investment strategy and operations of the fund. So anyone can comment on that in general, but I think it is even opaque for individual fund managers at sometimes to navigate that landscape and to get set up properly from a professional organization standpoint.
Yeah, absolutely. I mean, the qualified custodians, the banks that are very active in crypto are not the same banks and qualified custodians you'll see in the traditional space. So there's some education to be done around there. And that's, and even today, qualified custodians, they can really only custody assets that have been around and have liquidity and, have enough saturation where it justifies that cost. A lot of these younger projects, like funds are forced to self-custody or come up with other solutions in order to provide that level of protection for investor capital. So it's definitely a difficult space. And then it's difficult also from, a trade execution and management perspective. All the liquidity is scattered across the globe, if you include all volume, it's probably close to 400 exchanges. The majority of volume is on a dozen or so, but some are in the US, some are in Asia with zero regulatory oversight. And, it's difficult for a fund to set up entities that can interact with those liquidity venues in a way that provides comfort. So, much like John mentioned, we ourselves are a U.S. entity, so we have largely confined ourselves to trading on U.S. regulated exchanges and the CME.
Yeah, I mean, custody. Just one last point. The custody has really come a long way. You have Bitco that was just acquired by Galaxy, Anchorage, NYDIG. There are really good custody solutions available here in the U.S. That we feel comfortable as a family and as a fund parking our assets there, and that's a boon for the industry. So if an institutional investor wanted that beta exposure to Bitcoin, which I think everyone should have, and then have an alpha clip on like a Strix or an OBIG or a venture fund to go with it, it'll take a little bit because these are nascent crypto native firms, for institutional investors to get to know, but it's happening in real time. Sorry to interrupt, Scott.
Quick comment on that. I absolutely agree with our panelist peers here. Some interesting observations on the VC side include better understanding of how, in some cases, for some of the more esoteric assets, how these managers will self-custody and therefore their internal IT and network operations. And as a consequence to some of that, we are also, as part of our operational due diligence, better understanding some of the personnel and personal security, physical security requirements of the underlying managers. So because of the finality of these transactions and some scope for self-custody, it is a personal and personnel security concern in a lot of cases. So through to kidnap insurance and other considerations. And then lastly, we are spending more time on valuation methodology and the requisite valuation agents because of the volatility of the underlying asset class, and in some cases for some of these early projects, longer term lockup investing periods.
Yep, that makes a lot of sense. I want to double click on something, Nico, that you mentioned. I think, we hear a lot in that middle category of active hedge fund strategies. I think it's a little bit misunderstood in crypto as to like what is actually being traded, what types of assets are being traded, what types of liquidity, and the differentiation, quite frankly, between, a quant systematic strategy approach and someone who's, trying to run more of a long short strategy. I think one of those elements is that people often ask about is the ability to short a market that could move asymmetrically to the upside. So do you want to just touch on that, how you think about that in Strix's approach to the market? And John, I want to hear from you on OBIG's approach as well. But in framing why a quantitative approach kind of makes sense to you right now, given an early vol and early inefficient market right now, in many respects, like why that makes sense to you and why you've chosen that approach in the active hedge fund category.
Yeah, absolutely. I think a big portion of that is derived under this view that we are still extremely early, not only in terms of user adoption, but also in technology development, right? Like some of these chains are building experimental tech that has never been done before, and it's being done by semi-organized groups of developers like scattered across the globe. So on top of the complex market structure and fractured liquidity and perpetual futures instruments and offshore derivative exchanges that create all this complexity, you also have on top of that, like nobody really knows where we're ending up. Like we're still in inning one. So is Bitcoin the quote unquote one chain to rule them all, or do we end up with 50 different chains to have niche applications, or like all of these are unanswered. And Ethereum is one of the projects that I'm most excited about, but from where we are today to their end state is filled with death traps, more or less. So like that type of uncertainty and the market structure creates an insane amount of vol. And we saw, bringing systematic strategies from the traditional commodity CTA space, plus some of our own strategies over here. This allows us to capture this, exponential upside. If you buy that the space is an industry that's going to keep growing, but while allowing us to be nimble and not experience these 80 to 90% drawdowns, which are, a feature, not a bug of assets that have completely uncertain outcomes.
Yeah, I mean, I totally agree with Nico. I think we are in the early stages here. And I think evidence of that is Elon Musk's behavior in the last few months. He buy Bitcoin, Bitcoin go up. He really started that whole environmental FUD cycle he went through, and then spilled over to the China FUD cycle. And then, what was it, 2 weeks ago at that B Word conference, I think it was a Wednesday, he comes out and says that he owns it in SpaceX, and that was a dead low of the move down like right around 30,000. So we kind of triple bottom down there. Now we're hovering below 40,000. So the fact that one person with his Twitter account can move the market, one market so much, is just kind of telling how it is very underowned, and there aren't enough liquidity providers out there. And if you're one of very few liquidity providers, you can extract alpha out of the market. I mean, we decided to go from a quantitative route into crypto just because we already had the infrastructure, like I was saying earlier, with our flagship quant fund. So we could apply these quantitative models, both momentum based and machine learning based, to this new nascent market that is somewhat undertraded and somewhat needs more liquidity. The theory was that, and we did this with family money before taking outside capital. But the theory was that we could take these, CTA systematic type strategies, and then our newer machine learning models that we built out, and apply those to the crypto markets, and they would perform a lot better in the crypto markets than they would in the traditional futures markets. And so far, that theory is playing out. That's why we decided on quantitative. It helps me sleep better at night, taking a lot of the emotion out of the trading process. When you're using a quantitative approach and a more research-driven approach to the market.
Got it. Can you talk a little bit about maybe the evolution of, we saw, some of the early ARB and alpha be in simple things as price differentials between exchanges, and that was an early strategy. And then we've moved to John. You mentioned the basis trade. We were looking at 20 to 30% annualized returns in the difference between spot and futures, and that trade kind of came down in May and June as leverage came out of the system. Can you kind of talk towards where you see things going? And I think one of the things I probably observe happening is more depth and liquidity on more points in the futures curve, right, and across more assets, which gives kind of more opportunity to either take a market neutral or even a quantitative approach to those things, right?
Yeah, but we launched our fund in January, and we wanted a large, market neutral type arbitrage type strategies to be with our discretionary directional trading and our quantitative directional trading. At that point, CME futures were trading anywhere like 50 to 30% premium, so there was a large basis there. Grayscale was at a 30% premium. Unfortunately, basis collapsed to negative during the May sell-off, and it hasn't really found a bid again. So we're not really trading that right now. But you're also seeing that in the lending markets too. As it costs to borrow US dollar to put on an ARB like that, it's pretty much half of what it was at its peak. But basically, the basis, the futures curve, the funding rate of the offshore exchanges, and the grayscale premium will kind of follow each other. When basis will widen out, the futures were trading a big premium to spot, and the deferred contract were even higher premiums. The funding rate offshore would go up significantly. The Huobi, BitMEX, Binance futures. The funding rate would go up significantly, kind of break the market a little bit and kind of bring everything down with it back to normalcy. And so I'm not sure if the basis trade is going to bounce back in the next bull market. It really has been bouncing back with price since that low at the B Word conference. It may have been arbed away, just like the cross exchange arbitrage trades have kind of been arbed away a little bit. But I'm pretty sure the grayscale premium won't come back along with the grayscale arb trade, just because there are more alternatives out there to grayscale.
One of the things I think that we're starting to benefit from is sort of a better track record across the space, and that allows for quantitative analysis in additional to doing diligence on a team. And so I think Tracy and Nico and John, you're going to have a little bit different perspective. But, on the venture side, it's more about, vintages, and you can look to track records of previous funds. And Tracy, you mentioned some folks coming back to market here in Q1 and Q2, perhaps raising second funds or third funds. And you can look now to a track record of how at least the fund one has performed over a 3, 4, or 5 year time horizon. And then I think on the fundamental and quantitative side, we're now starting to look at Sharps and Sortinos and other types of risk metrics. So I'd love you to all to more comment on how that's framing in more of an institutional conversation as diligence becomes more of levels up, right, so to speak, and these metrics kind of become more important across the space. Anyone can take that first if you want.
Yeah, I mean, that's definitely the case in more institutional allocators. Obviously allocators care about, how much risk you're taking to get a specific return. I think early on when we started and our LP base was largely high net worth. I mean, it was as effective and simple of a pitch as defensive crypto, right? Like you're in a systematic strategy, you're not going to draw down 80%, or at least you shouldn't, or that fund manager failed. And but you can still benefit from the exponential upside, the asymmetric upside of the space if you think it's a long-term thing. As we move towards, fund of funds and family offices, you're exactly right. It became much more about, targeted performance metrics, what's that looked like historically. A lot of them, at least a lot of our fund of funds are, then taking our live return stream and, plugging that into their own allocation models and seeing how adding an allocation to us impacts their overall portfolio.
Yeah, I mean, Nico, that was a great explanation. I'm not sure I have much to add to that. I will say early on that the venture funds were able to raise more money than the hedge fund, just because they're investing in an underlying, U.S. company. It's a lot different than giving money to a manager and he's moving it offshore to, some offshore unregulated exchange and trading with it, using a lot of leverage and getting liquidated. So I think that, and then this is because I'm passionate about this, is moving all of that offshore business onshore through the FCMs in a regulated way, which is safer for family offices, it's safer for institutions that want access to these markets. I think that, like us as a fund, we're going to grow with liquidity onshore as liquidity grows. And I think that'll be great for institutions as well. And they'll be more comfortable, along with the longer track record, along with the more assets under management, but also the US-based infrastructure. The stronger that is, the more that institutional investors will be comfortable investing in a hedge fund type strategy that's trading on exchanges in the crypto market.
I think all of that is fair, as we've had some observations on some of the liquid and illiquid side as well. A couple of the things that stood out to me in terms of VC exposure, commented on some of it, is stage exposure, as we said, the earlier stage and kind of the convicted bets on projects that ultimately play out over time. Ownership, we talked a little bit about, and kind of being nimble around both the split between ownership and governance, true to the crypto ethos. Allocations in tokens versus equity participation, and how I think the general view of VC funds is that the token or coin exposure is more appropriate for venture capital investing. But of course, there's that, I'd say that there's a dissonance from the way that venture capital has historically invested in illiquid positions where the tokens and coins become liquid over time, and subsector diversification. So a big move by some of the top funds more recently, and big drivers of return included decentralized finance and some of the infrastructure related investments over time. Then that moved over to NFTs, and we'll see how the market plays out prospectively. I think a couple of creative ways to think about the market is evaluating some of these funds is, we commented on a little bit of this, Scott, in our upfront discussion, but I'd be interested in understanding, as we potentially move away from proof of work for more projects, including Ethereum. I would be interested in how much, I guess, hash rate exposure institutional LPs are exposed to, and that hash rate risk. This is sort of a departure from, I think, the way we think about underwriting funds. It's a little adjacent, but if you're primarily exposed to Bitcoin, you're probably primarily exposed to hash rate risk, right? And hash rate is a function, measures the computing power of the network and the underlying security and resilience. And so we saw, hash rates peak in May. John commented on some of that in terms of the pullback from the mining activity in China. So I think what I would be excited to see is a look through to hash rate and activity as it relates to geographic exposure, network security, as I mentioned, energy diversification, capital source diversification. We're seeing more activity going to the Nordics and the United States, as some of us have commented, and then ultimately, I think that will assuage some of the volatility in the market, whether it's China FUD or maybe some mining equipment dependencies and the dependencies on core and concentrated set of miners. So I'd be excited to look through in terms of risk around sort of hash rate diversification, security, and some of these underlying considerations. It sounds as though on the publicly traded side, Bitcoin will remain the most liquid end of the market and the most actively traded, and certainly, as we're seeing on the hedge fund side, the best sort of on-ramp for crypto traders and hedge funds to start to develop their exposure into digital assets in this underlying asset class.
Yeah, you mentioned hash rate. I think we've seen some interesting things on the on-chain, hash rate futures and ways to potentially hedge against those risks, from a miner perspective, or as you mentioned, if a manager or LP has a lot of exposure to that, there's developing ways to hedge those risks, I think, in the market, which is interesting.
Yeah, I never thought about an investor or an owner of Bitcoin managing hash risk. I guess like a short futures position could help with that, because there's two schools of thought out there. One, that hash follows price. The other is that price follows hash. So I've spoken with brokers that help miners, hedge against hash going up. But I've never had the thought of, me owning Bitcoin, should I be hedging hash? So I'm guessing there's ways out there to do it, and that'll continue to develop as well. But what we saw in China, everyone thought it was a negative. Kramer's on CNBC saying he's selling all of his Bitcoin because China's ruining Bitcoin, the Bitcoin network, and banning mining. And now, we've been dealing with China FUD since the very beginning. The school of thought was that, I know this is incorrect, obviously, that China controls the Bitcoin network because they have majority of the hash power over there. But now we're seeing a great migration out of China to the West, and I think that the Bitcoin network took it really well. So we kind of tested it in real time. Hash rate came down 27%. But the block times were a little slower then, but we still kept making blocks, and now you're seeing new rigs come back on and hash rate go back up. So that's an interesting thought, Tracy. You got me going here.
Ken, I'm going to ask you to pull up the results of that poll since we only have about 10 minutes left, just we can all look at this in real time. Okay, so mostly investors, as participants, how do you feel? How do you currently feel educated on cryptocurrencies? Somewhat educated, so hopefully this panel is somewhat helpful in that journey. Are you currently invested in cryptocurrencies? Yes, personally, 35%. Yes, personally and professionally, 29%. So it's good correlation there. We still got 32% on no. I think we got to change that. We need to change that. There's a lot of different and unique strategies, a lot of different ways to get into this market. So, happy. I think everyone on this panel is happy to help change that no from a yes to no to a yes. What vehicles do you consider to be smart and comfortable? 65% hedge fund. Interesting. 58% systematic quant fund. Nico and John like that answer, I think. Multi-manager fund. All right, we'll take that win at Galaxy Vision Hill, 42%. Tracy, I think you like that one as well. An ETF, 45%, pretty high there. I don't know what the panelists' thoughts are on when an ETF comes to market. I think that's been debated hotly on many different panels. We don't have to go deep on that one, but interesting answers there. And then let's see, what are the roadblocks to investing? I think this is a good segue into the last part of where we should really cover, because I want to make sure this is tangible takeaways that we can talk about out of this panel. So what are the roadblocks to investing in Bitcoin or other cryptocurrencies? Looks pretty evenly spread, not safe, easily hacked, 29%. Maybe we should touch on that for a second. Does anyone want to take sort of the not safe, easily hacked question around Bitcoin or cryptocurrencies in general? Just a comment on that.
I mean, it's much less of a concern than it was just a few years ago. Exchanges have prioritized custody. Qualified custodians that John had alluded to earlier have hit the scene. They're all very good qualified custodians. They check all the boxes what an institutional investor is looking for. They're just not names that are well known by more traditional investors. Yeah, I mean, as long as you're operating within regulated entities, I think you have very minimal exposure there. It's largely when you bring investor capital offshore to these unregulated exchanges that risk kind of increases exponentially.
What do you see, Nico? What do you see as, in your view, the biggest current hurdles, or what do you hear mostly in the conversations as you're talking to investors about investing either in your fund or digital assets in general? What are those things you find yourself addressing, and how do you counteract that with what you see as the opportunity set here?
Yeah, I think the biggest thing is I'd start with trust. Like, a lot of managers in this space are young. They don't have a limited track record. Or they do have a limited track record, excuse me. And the second thing is really education. The space is complex. I think Bitcoin had its moment last year because of the macro concerns. And it's easier to understand, right? Like the pitch there is this is a digital version of gold. There's a set amount, and that can offset some concerns around fiscal spending or fiat inflation. But the rest of the asset class gets exponentially more complex very quick as you go down the rabbit hole. I mean, I've been actively in this space for 5 or 6 years now, and I don't understand half of it. So I think it's a combination of trusting managers and then just time to understand like what's being built here. Like, if you say to somebody Ethereum is the base layer for Web 3.0, and then you're gonna have decentralized social media, decentralized banking, like that's a whole different world to wrap your head around than just here's a digital version of gold.
Got it. John, what do you see as the biggest opportunities kind of going forward and takeaways for investors? If I think one of the takeaways from that survey was that people are still very much in their education journey. Almost a third are in that education journey. And so what would you see, that tipping point to say you really kind of need to look at this space, you need to dig in, you need to do your work, and why, right? What's the opportunity here?
Yeah, well, I think everyone is going to have their own tipping point. My tipping point was in 2017 when we first started trading it, and I had no idea what a Bitcoin was. It was kind of a ready, fire, aim approach where, okay, let's just start trading this thing and see how the returns are. And it ended up being really good returns. So then spent 2018 learning what the underlying technology is. And to echo Nico's comments, I'm still learning every day what it is, and all these offshoots with different chains and side chains. I have way too many podcasts now that I follow that I can't, physically actually listen to them, as they come out. So everyone goes down the rabbit hole on their own. Everyone has a different skill set and background, and they tend to apply that skill set and background in some ways to Bitcoin. Ours came from the trading side and investing side. So we just kind of stuck to our knitting where, we're trading this asset just like we're trading other assets. We're investing in companies just like we invest in other companies. And on the brokerage side, we're onboarding clients to trade this asset class just like the other asset class. Everyone's going to go down their own journey, their own rabbit hole. It's going to be a different time. I think that this bull market's getting a little bit long in the tooth since, what are we? It's 14 months after the last halving, and usually the the bull markets last about about 14 months after the halving before they start peaking out. But so who knows? Maybe this is a super cycle. But it's the bull markets that get people interested. Gets people interested in the network. It's an opportunity to make money. You're incentivized to learn what it is, so you can participate in this open monetary system. So the bull markets, you got to be careful on the bull markets. Don't buy too much at the top, but the bull markets is when people get attracted to it and start educating themselves. But you just got to manage your risk.
Got it. Got it. So Tracy, I'm going to give you this one from our Q&A. We have about 5 minutes left. So if anyone wants to, add questions to the Q&A, we can answer some audience questions here. But I'll handle the first one. Where should investors be focused for the second half of 2021, and where do you see the most interesting strategies evolving?
Sure. Most of my focus personally at my firm is on the venture capital side. So what we're seeing in terms of interest includes more geographic distribution outside of the United States. So if you already have kind of a foray into digital assets, including maybe Bitcoin and Ethereum exposure on a direct basis, some passive and other passive index exposure, and some VC exposure, I think one area of diversification might be geographically, for example, or bespoke sector focus areas, including decentralized finance. So that's some of what we're seeing in terms of augmenting or adding to an existing portfolio, an early existing portfolio in digital assets. And I'd be remiss if I didn't mention, as a large scale hedge fund advisor, I think, and for the benefit of the panelists on the team here, I think increasing activity into hedge funds will hopefully play out over the course of the next year plus or so. We have continued to engage at Allborn in early investment due diligence into many of these hedge funds that have some exposure. We are pretty well apprised on the operational due diligence side, and I think as more gatekeepers and advisors like Allborn start to do more work in that space, hopefully it unlocks the opportunity set. Again, bodes well for maybe John and Nico. I think that hopefully that plays out nicely in a diversified portfolio as we think about as in a diversified portfolio.
Got it. So we have a question coming in around capacity. So I think this is it was specifically addressed to Tracy. But how do you think about evaluating capacity in hedge funds? I mean, I can comment on it as well a little bit. But I think we're seeing certain capacity constrained strategies, especially in the market neutral category, around alpha and ARB oriented strategies, and a little bit in some of the emerging DeFi things. But what's generally everyone's opinion on capacity and the expansion of AUM as the space grows?
I'll comment briefly, but I think John and Nico might be better apprised. I think a lot of, and you cited this, Scott, there are probably something like 400 hedge funds that are participating in the market, many of which are probably sub $50 million in total assets, probably more in terms of underlying exposure when including leverage. And that has dictated some of that market, that sort of sub $25 to $50 million of exposure, because, some of the barriers include those that are effective at trading while understand and have gone up the rigorous learning curve of crypto, as well as staying on top of the very dynamic market dynamics. So all those things have, I think, capacity constrained the top quality talent pursuing the market and able to trade in the markets. What we're doing to address some of that is, again, doing our best on the operational due diligence side to ensure, as hedge funds onboard more of this crypto trading, we're on top of some of the opportunity set and risk exposures.
Yep, you're right. Just to touch on that, we do track about 850 total crypto funds in the space, about 400, as you mentioned, on the hedge fund side, about 450 on the venture side, across many different strategies in our Vision Track product. So large top of the funnel, but when criteria to come down to what is probably a very institutionally investable strategy, it's a much smaller subset of that, as Tracy mentioned. Nico, you wanted to comment on that same capacity question? Yep.
Yeah, I would just say, liquidity in this space is much better than it should be given how small the asset class is. And that's largely because of the incentives for market making HFT firms to move over into the space and provide liquidity. And traditional asset classes, particularly equities, they're picking up fractions of a penny on the bid ask. But, you move over to crypto and you start market making, random altcoins, Bitcoin, you're now picking up $10 bills instead of fractions of pennies. So liquidity is pretty good. It's grown exponentially since we first started, back in 2018. And I expect that to continue to be the case. Where capacity gets constrained, like you mentioned, is the market neutral strategies. Like those opportunities show themselves when the bull market is on, when things are moving really hard. And, so then managers are sitting there wondering, should we, take the 20% annualized on the market neutral, or do I want exposure to this thing that's moving 100% a month? And it's kind of like a choose your poison. And we've seen people prefer the directional side than the market neutral, at least when it comes to what the gross returns look like at the end of the year.
All right, so we're going to take one more question from Q&A, and then I'll have a final question to wrap us up here. So, John, this one is probably best suited for you. Mechanically, what risks are unique to trading Bitcoin futures versus traditional futures on regulated exchanges, CME, CBOE, BOE, if any?
Well, since we were just talking about liquidity, I would say that was probably mechanically one of the risks Bitcoin futures compared to traditional futures. Traditional futures have been around for a long time. You have all the biggest market makers in the world making markets on it, all the big hedge funds, investing and trading in the traditional futures market. So liquidity is definitely a big differentiator. So you have to watch when you're throwing any stops in the market, you got to make sure you're doing it the right way. Weekend risk is an issue. We take down positions going into weekends just because Saturdays historically have been very volatile days just because there isn't as much liquidity. People on the offshore, operating the offshore exchanges, they don't have this risk, but operating onshore, we do. So we manage risk around weekends as well. Outside of that, everything is pretty much the same outside of the huge volatility. Implied vols bounce around from 50 up to 110, 120. But traditional futures participants understand that. They understand where, based on volatility, how do I size this bet? Considering how far away my stop is. So I think liquidity and weekend risks are probably still the two biggest.
Got it. All right. So we'll go to the final question, and I'll go to Tracy first on this, and then we'll go around the horn. What's your top prediction for 2022 that might be unexpected? It does not have to be a price prediction. Hopefully it's not. But what's your top prediction for investors for 2022?
I think at a high level, we're going to get slightly more regulatory clarity. What does that mean? I don't know, but I with some of the Tether lawsuit in New York settling down, and some of the audit related soon, some of these Chinese regulations, playing out in terms of Chinese mining activity, and potentially the ETF rising. I think slightly more regulatory certainty and not just strictly enforcement related out of the United States would hopefully be more constructive for the market. So not a price prediction, but I think the market will hopefully end up higher than it started at the start of this conversation. How's that?
Nice. Nico?
Yeah, I mean, funnily enough, in this asset class, I do think we'll see regulatory clarity, but I think the big thing that we're going to see is an explosion of decentralized derivatives and a continued exponential growth in decentralized exchanges. And I think that's what we're going to see in 2022, which will have knock-on effects for price behavior. So that's what we're looking for.
John?
Mine isn't much of a prediction, but it's something that I'd like to see. But I think a central bank buying Bitcoin would be really interesting. There's less and less interest in foreign demand in the U.S. Treasury market. And central banks like the Swiss National Bank have started buying things like Apple stock. El Salvador made it Bitcoin legal tender. So after financial institutions bought, corporate treasuries have bought. The last big source of wealth is central banks. So hopefully it happens.
All right, so I'll finish. Mine is I hopefully can attend an in-person concert maybe in 2022 if we can get COVID to calm down. But other than that, I think, my side, I think we'll see multiple 1 billion plus, both individual fund managers, right, across all the strategies we talked about, and also on an aggregate platform basis. We're going to start seeing digital asset managers really level up on assets under management across a lot of different differentiated, unique strategies, and I think that'll be good for the space overall.
Amazing, fascinating. I really, you talk about the educational journey. That was a huge boost to mine, which is, nil up until these last two webinars, which is fantastic. I want to thank you all so much for really adding, talk about clarity, a lot of clarity to these markets and ways to invest in the coming institutionalization and potential regulation. It sounds like it's all really good stuff. I want to thank our audience. I hope everybody has a terrific weekend and can digest all of this. We will not be back next Friday, but we will be back for our final webinar in our summer series on August 13th, and we're going to talk about managed futures and macro strategies. And I hope that you can join us then. But thank you, Tracy and John and Nico and Scott. Fantastic. Thank you.